Hi class, this is your instructor, and I want to go over some of the highlights out of Chapter 9, talking about cash. And in business, cash includes currency, like the dollar bills, coins, checks, money orders, and funds on deposit in a bank. So any of those items we call cash. And Max Out Sporting Goods, the company we're doing work for, has two major sources of cash. They receive checks from credit customers who are making payments on their accounts, and they also receive currency and coin from cash sales when a customer comes in and purchases something with cash. Now, Max Out Sporting Goods uses a cash register to record the cash sales, and at the end of the day, the store manager prints the transaction totals from the cash register, and a cash register proof is prepared. This is verification that the amount in the cash register agrees with the amount shown on the cash proof. Now, the cash register proof verifies that the amount in the cash register less the change fund, the amount you started with, equals the amount shown on the cash register transaction totals. Now, sometimes the cash in the register is more than or less than the cash listed on the audit tape. If some of you have worked retail before and been responsible for a cash drawer, you know that it doesn't always come out perfect at the end of the day. A cash over exists when the cash in the register is more than the audit tape, and a cash short exists when the cash in the register is less than the audit tape. We're going to record short or over amounts in a new account, which is in the expense section, called Cash Short or Over. That's the name of the account. If the account happens to have a credit balance, it's treated like a revenue. So if you have more cash in your drawer at the end of the day, you just made the business some money, some revenue. If the account has a debit balance and you gave out too much change, it's treated as an expense. So we're going to look at some transactions here that might occur. Max Out Sporting Goods keeps a $200 change fund in the cash register. And that just means at the beginning of the day, the clerk has $200 in cash in order to make change with. So on September 29th, the cash sales on the cash register tape showed $2,200. Those were your sales. The cash count, when you counted your drawer at the end of the day, was $2,397. And we want to record the cash sales for the day. Now, we counted the cash, $2,397, but when we take out our beginning cash drawer, so that we subtract $200, we actually end up with $2,197 worth of cash. So we are going to go over here, and I've set up a little general journal, and we're going to record the transaction. At the end of the day, this is what transpired. We had on September 29, we're going to debit the cash account for the full amount of the cash that we brought in minus the change fund that we started with. So we're going to end up with $2,197. That's how much came in. And just for the sake of making this easy, I'm going to skip a line and I'm going to credit the sales account, because at the end of the day, if we look at our cash register sales tape, it shows that we sold $2,200 worth of merchandise. Okay, so I have to make sure my debit column equals my credit column. And in order to make these two balance, I'm going to need to put $3 in the debit column. Because that's in the debit column, I know I have a cash short, because that's like an expense to my business. Now, technically, I should debit cash short or over right here, because that's the name of the account. But what I usually do, just to make it simple and help me keep it straight in my head, is just record it to cash short when I was short money, or cash long when I'm long, but it still goes to the same account. And then if I was going to put a little description, I would just say record cash sales and shortage. Okay. So that's how I'd record the first transaction. Looking back at my study guide. And the second one here, it says on September 30, the cash sales on the cash register tape showed $2,100, and the cash count at the end of the day was 2,301. Now, remember I have to subtract out my $200 change fund, so I actually brought in $2,101. So I'm going to go back over to my journal, and I'm going to record September 30th. I'm going to debit the cash account for the amount of the cash I brought in minus my change fund. So $2,101 is what I brought in. I'm going to skip a line and credit the sales account for the amount that showed on my cash register tape, which was $2,100. So now here I have a difference, and it's going to take $1 on the credit side to make that balance, to make both sides be $2,101. So in that case, because it's a credit, I'm going to credit cash over. Technically the name of the account is cash short or over, but I'm just going to put a cash over. I just made the company $1. And then again, a little description, record cash sales and overage. Okay, so that's how I'll record sales for the day, cash sales for the day. Now I look back at my study guide, and another time that we need to record cash is if we collect on a promissory note. And from time to time, if a customer who originally charged a purchase and owes us money can't pay by the due date, we will have them sign a promissory note that just tells exactly the specified amount of money is due on a certain date with a specified interest rate. So here we have a situation on September 30, Max Out Sporting Goods accepted a 6-month promissory note from Stacy Fairley, who owed $800 on her account. Fairley had asked for more time to pay her balance, so we agreed to grant more time if Fairley signed a promissory note with 9% annual interest. The note provides more legal protection than an accounts receivable, so we're going to record that transaction. So I'm going to go back over to my general journal, and that was on September 30. Okay, first thing we're going to do is take the $800 that Stacy Fairley owes us out of our accounts receivable account and put it in a new account we call notes receivable, because we're having her sign a note, which is just basically a loan that says she promises to pay with within a certain time at a certain interest rate. So I'm going to debit a new account called notes receivable for the $800 that she owes, and I'm going to credit accounts receivable / Stacy Fairley. I'm going to credit it for $800. Now this takes her $800 amount out of our accounts receivable list and puts it into another account called notes receivable. And we're just going to say, for a little description, 6-month note, 9% from Stacy. Oh, I guess I'm spelling her name wrong. Fairley. Okay. Now the next transaction, it says on March 31st, which is 6 months later, the due date of the note, Max Out Sporting Goods received a check for $836 from Fairley, which covered the principal amount of the note, $800, and the interest that's owed for the 6-month period, which is $36. So we're going to record that transaction. So here it is, March 31, and we got some cash from her, totaling $836. Now we're going to credit notes receivable for the amount of the note, which is $800. But we're also going to credit a new account called interest income. It's a revenue account, so it has a credit balance, and we earned $36 in interest income. And we could just make a little description. Payment received from Stacy Fairley on notes receivable. And just to show you how I figured that $36, principal times rate times time. Do that again. Principal times rate times time is the formula for figuring interest. And so in this situation, the principal was $800. So 800 times the rate of 0.09% times the time, and in this case it's 6 months out of a year. So I'm going to put okay, I've got $800 times 0.09 times 6 divided by 12, 6/12ths of a year, and that, when I put that in as a formula, it's $36. So that's how I got that. Okay, those are the first few transactions from this chapter. We'll stop here and pick it up on the next tape.